All right. Well, welcome back to our second technical training of the season. What we're going to be working on today is really kind of reviewing, as Ezra mentioned, items of income. So what we had covered last week was actually a lot of the decision-making process you have to do with the entire 1040. So what we had covered last time was really taking a look at filing status and amount of dependency. That really covered the first third of the 1040. What we're going to be covering today is actually getting in a little bit more detail, taking a look at lines 7 through 22. What are the common forms of income? And so as Ezra mentioned, what we're going to be doing is actually changing the presentation. We're going to be showing you what those forms of income look like, give you the reference to the 4012 so you understand how that information will be simply input into our tax layer program. But really what we covered last week is a lot of those areas that you have to actually think about. You know, is the person married or are they not married? Relatively simple question, then we'll go through our filing status. So what we're going to be doing is walking through a Prezi demonstration essentially of the income tax return process. So if you get motion sickness at all, please try not to watch the screen as the things move. They will be moving around. We can just simply follow along. What we wanted to show you was the first page of the 1040. As we mentioned last time we were here, we actually went through understanding how to fill out the first part, the taxpayer, the spouse, the address, any dependency that we have, taking a look at the exemptions starting on line 6, A through C. So those were the areas we had covered. Now what we want to take a look at is a little bit more detail, taking a look at lines 7 through 22. And those are going to be the common forms of income that we'll be seeing and reporting on the income tax return. So today's session is really what can the IRS possibly tax? If you stay tuned 2 weeks from now, we'll say how do we start taking deductions and more importantly credits against that taxable income. One of the first questions we usually get within taxation is what items are subject to tax? The IRS has a very good answer for that. Under the Internal Revenue Code, anything you get that increases your economic wealth is considered taxable, unless they tell you it's not. And if we take a look at the D1 form on your 4012, we'll actually go ahead and take a look at some of those common forms of items that are going to be taxable, and more importantly for our volunteers, and also our clients here within VITA, what items are not taxable. So we're going to be covering the main items that you'll see throughout the VITA process, and again, these common items that we take a look at may be dependent upon what type of site you're at. If you're going to be at a retirement home, you're probably not going to be seeing a whole lot of wage income, but you will see a lot of retirement distributions and Social Security income. If you're at a more general site, you will probably be seeing things like wages, interest, perhaps some dividends, some unemployment compensation. But the nice part is we'll be showing you the information as provided on government forms. All the training that we're going to be doing tonight is ready for your basic certification. There may be a couple other things that we may talk about, areas of self-employment income. That's actually an advanced topic that we'll be covering one of our last sessions here for training in December. So you're more than welcome to come out and try that if this part's going all right for you. But really what we want to show you are the forms that you'll be getting from clients and how do we kind of identify those and make sure we're reporting them effectively on our income tax return. Some of the main things that we're going to be taking a look at taxable income are going to be things like wages, interest, dividends, retirement plan distributions, and we'll talk a little bit more about that. We'll talk about unemployment compensation, Social Security payments, and there are a couple other items of taxability you may find as you go through the process. Items of jury duty are actually taxable items of income. But one of the big questions we always have is what items are not taxable? So if a client comes into VITA and says, I had received an inheritance from my uncle, how much of that do I need to report to the government? The great answer is none. You don't need to report inheritance. You don't need to report gifts. Payments made on account of injury or sickness are not taxable either. So if you take a look at the bottom of the D1 in your 4012, it's going to go through a lot of those areas that are going to be considered not taxable income for federal purposes. And we'll kind of walk through and make sure that you have a good understanding of what is and what is not going to be subject to tax. As we go through today's session, we're going to be taking a look at those most common items, starting off with the Form W-2. Just as a matter of course, if you get documents from a taxpayer, and probably some of our returning volunteers can indicate how you get some forms. Some people will have it all nicely organized, all ready to go in nice order. Some will bring in any piece of mail that looks like it's an important piece of tax information, which from January through April, a lot of things look like they're important pieces of tax information. So probably some of the returnings have had some experience of helping to open letters and deciding This is a mortgage payment. You need to make this. This is not part of what we need to do here for tax prep. But just to let you know, if you do see some forms coming through, pay attention. If they have a 1, a 0, a 9, an 8, or a 2 in the number, the IRS is most likely going to get a copy of that form as well. So anything that looks like an official document, these government forms coming through, like a W-2, the IRS will get a copy of that form as well. So it's going to be important that we follow the information that we receive from the clients and enter it into TaxSlayer. What will happen if we don't enter all the information, the taxpayer will get a nice little letter from the IRS a couple months after the return's been filed, basically saying, "Dear taxpayer, we believe that you failed to report some income." And it's not really as nice as that is. It's a little bit more direct, and say that if you just send us a nice large check, we'll go ahead and we'll just ignore the whole issue. Generally what happens, there may be a case where a taxpayer may have forgotten to bring a piece of information in, or maybe as we went through the process, maybe something was misidentified. Usually what happens is Steve and Ezra get some nice calls around September, October timeframe to get to resolve those issues. But just as a reminder to our preparers and to our clients, if we get a document issued in their name, in their social security number, and it's an official government form, the government will get a copy of that. They are going to look for that information to be reported on a return. So if they get it and they say, "Oh, I don't want to report this W-2," bad news for them, the government will know the W-2 is part of their taxable income, so we need to report it anyway. Just want to kind of mention a few things about the W-2. All the information we need to prepare the income tax return will be found on the government form. They all have the same boxes. The problem we run into is the government hasn't specified the exact form all W-2s need to look like. So there may be some variations in what a W-2 will look like. The benefit is they all have the same pieces. They all have the same boxes and everything else that we'll be taking a look at. So the most important things we're going to be addressing here are understanding what information do we need to pull over. The nice part about TaxSlayer, because we're entering the second year, if the client was with us in the prior year, we can roll over their return information. The nice part about TaxSlayer, it will bring up all the W-2s the taxpayer had in the prior year and ask you which of or any of these do we want to roll forward. So if you know they didn't have a job in 2017, but they had one in 16, you do not need to roll that W-2 forward. It's going to save a lot of typing by bringing over W-2s from before. It's going to bring over the social security number, the employer identification number, the address. All we have to do is fill in the brand new wage information. Just as an aside, it's not going to bring over prior year wages. That would not be a good thing, that it automatically assumes you had the exact same as last year. So we have to fill that in each year. Another kind of nice part about TaxSlayer is once you start entering information, if you get a W-2 and you start entering the employer identification number in, as long as you're not the first person to enter that W-2, the rest of the information should populate. It's going to go ahead and search the database, and if someone else at your site's entered that information, it's automatically going to start filling in the name and address. So the trick is, don't be the very first volunteer to do anything at your site. Just wait about a week or two, and then that way most of this information should be input. Just kidding. But what we want to take a look at is to make sure that the information we enter off the W-2 is as it's presented on that government form. We want to be sure that the employer identification number matches. We want to be sure the addresses for the employer and the employee are as they're shown on the W-2. So there may be some things that we have to change just based on some information. If the employee moved or something along those lines, we just want to be sure we have the correct information. Other than that, what we're going to be concentrating on are going to be these boxes. These are going to be the important areas of information. So no matter how the W-2 is going to look, we're always going to see taxable wages in box 1. That's the amount that's going to be reported on the federal income tax return. That's automatically going to flow over to line 7 on the 1040. The other important box is going to be box 2. That's how much federal income tax was withheld. That's going to help determine what amount, if any, will the taxpayer be getting back in terms of a refund. The other things we're going to be taking a look at are Social Security and Medicare wages. Generally, this information will automatically flow from the top line. However, there may be some instances where those Social Security and Medicare numbers may be different than federal taxable income. For purposes of employees who contribute to a retirement plan, any contributions made on a pre-tax basis will reduce their federal taxable income, but not their Social Security or Medicare. One of the techniques we generally use is before you start changing the Social Security and Medicare, go down to box 12 and start entering some codes there and see if that'll change the Social Security. Then go back and just verify the information is going to be exactly as we see it on the W-2. So before you have to start retyping everything, you may want to go to box 12 first and start typing in a few of those codes. But again, what we want to be sure is we're just entering the W-2 information exactly as it's presented. And this will flow to the income tax return. We don't need to do anything else other than making sure the information is entered. Now in our case, in this example, we're not showing anything in box 12, but that would be on the right-hand side of the screen. If there's any codes in there, it will automatically flow to the appropriate form within TaxSlayer. So the most common ones we'll probably see are going to be a code D for a contribution to a 401k plan, a code E if it's a contribution to a 403b. There may be some other codes in there. If you have any questions of what the codes are, easiest thing you can do is either A, turn the W-2 over, all the codes will be listed there, or we also have a list of the common W-2 codes on page D6 of your 4012 at the bottom. So those would be the common ones that we see. If we enter those codes in box 12, they will automatically calculate and flow to the appropriate areas on the 1040. We do want to note that the information in box 14 is supplemental information that will not carry anywhere else within the tax return process. What we're going to be taking a look at here in this example is we do have some local and other state employment taxes withheld. If you see a code LST, it's a local services tax. That's a tax based on the privilege of working within the municipalities here in Lancaster County. It's a tax collected and then remitted back to local municipalities to help offset their volunteer services. That is a tax on employment, which would actually be considered a deductible tax for itemized tax purposes, which we'll cover 2 weeks from tonight. So if the taxpayer is itemizing deductions, we want to carry this information over to the Schedule A itemized deductions, and we'll show you how to do that in 2 weeks' time. The other item we see here is called SUI, sometimes known as PASUI. It's state unemployment insurance. It's the employee's portion of unemployment insurance withheld from their wages. In the Commonwealth of Pennsylvania, the employer pays a portion of unemployment insurance, and so does the employee. So when you're collecting unemployment, you're actually collecting part of your own wages you had withheld if you collect unemployment. Since this is an employment-related tax, it is also deductible if a taxpayer is going to itemize deductions. So again, we'll talk about that when we get to itemized deductions in 2 weeks' time. But just some information in box 14, you may want to review it. Just be sure that there may be some other opportunities we have to enter that information somewhere else on the return. And we'll cover a lot more of this as we go through the training in January, so you get to work with the tax program a little bit more closely. All right. Oh, yes, question.
Yeah, back on the name address of the employee and name address of the company.
Yes.
They have to be entered exactly as on the W-2?
The IRS would prefer that we enter those exactly as shown on the W-2.
For example, if a client worked at 2 addresses,
Right.
of course, so one W-2 has the previous address, the second has the new address. You don't think that you enter as each W-2 is listed?
Correct, right. And the reason why we do this is just for the IRS matching program. They try and get as much information as possible that they know that they can match up the W-2s appropriately. So the recommendation we're getting from the IRS is to enter the information exactly as you see it on that government form. So as long as your taxpayer didn't move multiple times throughout the year, hopefully it won't be too difficult to go through that process. But we do want to try and enter it exactly as shown. The Social Security number that we enter should actually help pull the information from the front screen. But if they did move, and again, what we're going to use is that taxpayer current address. So if we're seeing a client in March of 2018 and they moved in February of 2018, we're going to use their brand new address for the purpose of the 1040. So we may have to go back and correct all those W-2s, which would still probably show their previous address. Yep. Okay, just one other point on the W-2. We do have some state and local information reported here as well, and Pennsylvania is a Commonwealth that does tax. If you don't like state taxation, I suggest you try and volunteer in Florida or Texas that do not have a state income tax. Their VITA program saves about 10 or 15 minutes per return. They don't have a state income tax. We in Pennsylvania do. Now, what we want to take a look at is the state tax that we're going to see in box 16 may be slightly different from our federal taxable wages. Generally, what will happen is the state wages should be the exact same that what we have for Medicare. We'll talk a lot more about some state differences once we get to that section in training, but just a very brief explanation. Pennsylvania does not tax retirement income. So it's a very favorable state for retirees. They do not tax Social Security, do not tax retirement income. So Pennsylvania does not allow a deduction for contribution to retirement plans. So they do not allow those same deductions that we can take for federal. So generally what we'll see is the state wages should be exactly the same as Medicare wages. So you may need to make an adjustment. TaxSlayer will traditionally try and fill in the state wage to be what the federal wages are. So we may have to go back in and make some adjustments. Local wages should be exactly the same as state. Again, we'll make some reminders here when we get to the state and local section. But just watch and see what happens with the Box 19 local taxes withheld. On occasion, an employer may show an LST payment of $52 in there. It should be reported in Box 14. We just want to watch to make sure we don't double up and count additional local withholding. There may be some situations where there may be two different local taxes withheld. Either the employee may have moved throughout the year and the employer caught up to the change in rate, or the employer may have shown both areas that they withhold, both the municipality and the school district. So we'll talk a lot more about the local taxes in a separate section, but just want to kind of give you a reminder here on the W-2. Enter it exactly as you see it, but there may be some things we need to adjust as it comes to Box 14 or some of those local areas. Okay, any questions so far in the W-2? Once we enter that information, it's automatically going to flow to line 7 of the 1040. So once we get all the W-2s in, it's automatically going to carry over. Once we be sure we have the correct state and local, the state will go over to the PA, and the local will explain how we handle that in a couple weeks. Hopefully we'll have a different answer for you, but we'll see how that goes. All right, so in addition to the W-2, we may see some additional forms of income. This may happen on occasion. Any bankers in the room this evening? Okay, all right. We may not see a whole lot of 1099 INTs with clients coming out of VITA. The main reason is when we take a look at the VITA program, we're generally finding taxpayers that have less than $62,000 of income. I'm not quite sure how many of you have gone to a local bank to see how much they pay in interest on a savings account anymore. It's not 1970s interest rates. You don't even get a free toaster anymore to open an account. We're talking about very small rates of interest. So this may be the only time that you see a 1099 INT the entire season, other than maybe for purposes of your certification exam. But we just want to show what this looks like. We also have clients that may come in and say, I don't know why the bank didn't send me a document. I know I got interest income. The only way that we have a 1099 INT requirement is if it's, the taxpayer is $10 or more. So quite often we'll see someone have, they bring in their last month's bank statement and they say, I'm not quite sure why the bank didn't send me the document. I know I have interest income. They bring the form in and they have 73 cents that was credited to their account for the entire year. If they would like, we may certainly put the $1 of interest income on the return. It most likely will not impact most of the information on the income tax return. So if they would like to report it, we can certainly put it down there. If they do bring in a statement, sometimes we'll see some credit unions or savings and loan institutions. They pay a little bit higher rate of interest traditionally than some of our national banks. They may bring in a statement and it's going to say dividends earned for the year. That's actually interest income. So if you see something coming from a credit union and it says dividends earned, it's actually interest that they've earned on those accounts. And again, we can simply enter that information with the name of the institution and how much interest income they've earned. But we decided to go really complex with the 1099 INT here for you. This is going to be the most exciting 1099 INT you may see. What we have in this case is we have two different items of interest income. One is we have traditional interest. This will be coming out of a financial institution paying interest on an account. In order to get $56.20, the taxpayer, I believe, had $475,000 sitting in their account for the entire year, payable at a national bank rate. If you see anything in box 1, that's going to be carrying over to our interest income line. Generally, most of our taxpayers within VITA do not need a Schedule B presented. It will only happen, it will populate itself if it needs additional detail. But basically what we're going to do with this form, if you see a 1099 INT, we're going to enter the information exactly as shown. Box 1 will always be interest income. In this case, we're also going to show something in box 3. That's going to be savings bond or interest on U.S. obligations. The interesting part about U.S. savings bond interest is it's taxable only for federal purposes. The feds have the ability to tax their own money, but they don't allow anyone else to tax it. So the feds can tax their own U.S. savings bond interest, but they will not allow the states to tax it. So it's going to be taxable for federal, but not for PA. And we'll talk a little bit next week about, 2 weeks from now. Next week will be Thanksgiving. You do not need to be here after a Thanksgiving dinner and go through tax. It's already going to be trying to put you to sleep. Last thing we need is everyone coming here after, belly full of turkey and stuffing and trying to learn taxes. So we'll see you again in 2 weeks. But we'll talk about some savings bond exclusion. If you have a student who's going off to college, there may be some opportunities to exclude the interest off savings bonds if you meet certain requirements. So we'll go through some of the areas for that exclusion. But otherwise, if you see anything in box 3, if someone says, I've cashed in some savings bonds, I've had these things for a number of years, and the bank will go ahead and automatically report how much they've earned in interest, that will be shown in box 3 of a 1099 INT. Again, that'll be taxable for federal, not taxable for PA. All we have to do is enter that information in, and TaxSlayer will go ahead and calculate that appropriately. So in this case, we have $56 of regular interest income, $25 of government interest. So when we enter that information together, we'll see $81 on line 8A. If we have any taxpayers that have a more sophisticated account, we do have a few taxpayers, I think, that have some managed accounts. Perhaps they may have some tax-exempt interest if they're involved in municipal bonds. That information would be reported on 1099 INT, and that would be shown up in box 8, tax-exempt income. If they did have any tax-exempt income, that would be showing up on line 8B. Again, not taxable for federal purposes. All right, so how many 1099 INTs have we seen in the past year? Any of our returning volunteers see a good bit of them? Okay, some, okay. So probably on a percentage of how many clients that come in?
3 or 4.
Okay, 3 or 4%, okay. So this may be one of the only times you're going to see the 1099 INT in significant detail. The other form that's going to be kind of unique, and we may not see a whole lot of these, are going to be these 1099 DIVs. And this is for dividend income. This is basically, we'll see this form occur in basically 2 different situations. One is if a taxpayer owns stock directly. If they own stock in a company, perhaps it's a local bank, other local company, or they may have a managed account. Perhaps they have an investment account with a broker, they have a mutual fund, they'd be getting a 1099 DIV. Again, what we're going to do is we're going to enter the information exactly as shown on the 1099 DIV. It's going to have a couple different areas. The first thing we're going to see is ordinary dividends in box 1. That's going to be the total amount of dividends the taxpayers received, and that's either in cash, or it could be, if they're involved in a dividend reinvestment program, the amount of cash they would have received, except that cash went to buy some additional shares of stock. So even if they say, I didn't get a dividend check, I don't know why I'm getting this, they might be part of a dividend reinvestment plan. So what that'll show is how much dividends would be taxable to them for the tax year. We'd simply enter that in the TaxSlayer program. What we'll see on box 1B is going to be this area called qualified dividends. As long as the taxpayers held dividends for a specific period of time, either before or after the dividend declaration date, what this becomes is a qualified dividend. It actually entitles them to a special tax rate. Qualified dividends are going to be taxed at either a 0, 15, or 20% rate. But you don't have to do the calculation. The tax system's going to do that for you automatically. What may be kind of unique is if you see some taxpayers come in and they have investment accounts, they have some qualified dividends or long-term capital gains, they may show taxable income on their return, but have no tax due at all. And that's due to the beneficial rates that we see, at least based on the tax code as we see it today. We'll see what happens over the next couple weeks as we see a brand new tax bill go through Congress. That most likely will not have any impact on what we're doing this year, and we'll see what happens for training for next year. Training next year may be all of 30 minutes, or it could be 13 weeks. We'll see what happens with the tax code, so we'll see how that goes. But as of now, we have this position of qualified dividends. They'll be entered in, they'll simply carry over to the income tax return, and that will automatically calculate how much tax will be due on that amount. The other thing we may see, particularly if you have a mutual fund, is this concept called a capital gain distribution. This is an amount that the mutual funds generally have because the companies have passed through capital gains to them. They're simply accumulating those and passing those on to their ultimate stockholders. So if we see these capital gain distributions, again, they'll be showing up here in box 2A. That'll just be going ahead and carrying over to the appropriate form on the return. So if we enter the information as we see it, and if you have any questions about what these look like, they're going to be on your form 4012 D11. A little bit more explanation for those. But when we take a look at our 1040, we're going to see these numbers populate. We're going to see 1256 show up on line 9A. We're going to see that $1,100 of qualified dividends show up on line 9B. And we're going to see the $100 show up on line 13. Now, what would happen if we do not have any other stock transactions? That's basically the extent of the 1040. We won't see any additional detail, any additional supplemental information. Okay, how are we feeling so far on that process? W-2s, interest, dividends? Okay, let's get in the world of retirees. Now we're going to get into a concept of what happens when we have distributions from a retirement plan. This one's kind of a unique area. We do see a good amount of 1099-Rs throughout the season, particularly depending on which site you're working at. If you'd like more information, this is going to be on the D33 of your 4012, just to give you some overview and some additional information. We also had a separate training on the 1099-R a little bit earlier in the season. We are going to be re-recording that for your viewing pleasure if you'd like to learn more information about the 1099-R, including some more complex issues. What we're going to be doing today is actually going through some of the basics, most of the things you'll probably be seeing with the 1099-R. Again, anyone who's receiving a distribution from a retirement plan will be receiving a 1099-R. And we'll show you kind of the key aspects that we want to take a look at. These forms are, again, the providers have a lot of flexibility in what they can do in order for these forms to be generated, but all the same information will be populated. Again, what we'll do is we'll enter the identification number of the payor. Excuse me. We'll also be sure we have their address as well. So sometimes you just want to double check. Sometimes with the larger institutions, they may be processing checks out of different locations, so the address may change. But the main things we want to take a look at are what's going to happen in box 1 and box 2A. Box 1 is going to show the total gross distribution from the retirement account. That's going to be the amount from the plan directly to the recipient. What we want to take a look at is what amount, if any, is reported in box 2A. Box 2A is actually the amount that's going to be subject to income tax. In most cases, hopefully what we're going to see is there is an amount sitting in box 2A. Either that amount will be exactly the same as box 1, which it happens to be in most cases, or there may be some situations where there may be an annuity or some other type of product, and not all of that distribution will be taxable, but the administrator has determined how much of that will be subject to income tax. So what we're going to do is enter the information again exactly as we see it. The amount in box 1, the amount in box 2A. But now there could be a few issues. We just want to kind of take a look at those here as we were kind of getting into the system. So one of the things we're going to take a look at is there's actually two different lines that retirement distributions will be reported on. One is line 15, one's going to be line 16. Line 15 is essentially for IRAs, SEPs, and Simples. What we'll see in that context, the system will automatically put these in the correct line as long as we fill out the input form correctly. If we see that in box 7 there's a check mark to say the distribution is coming from an IRA, SEP, or Simple, we just simply check that box and it'll automatically go to line 15. If it's coming from a pension or annuity, that box will be left unchecked and that information will simply go to line 16. Now what happens if we don't have something shown in box 2A? Every once in a while you'll get a 1099-R coming from a provider and they'll have taxable amount not determined checked on the box. So that'll mean line 1 will have an amount, line 2A will be blank. So we really have two different options that we can work with here. The first part's going to be walking through a client with a series of questions. Now the first question we're going to ask them is, did you make any contributions to your retirement plan with after-tax dollars? Meaning, did you have a contribution to your retirement plan that was not through a employer withholding program, kind of on a pre-tax basis, were any of the contributions funded something other than by the employer, whether it's an employer match or employer profit sharing plan? Did somehow, after you had the plan established, did you decide to write a check to the plan with after-tax dollars? If they say, yes, I did, what we do at that point is we gather all their information together, put it in a nice stack, and slide it back across the desk to them and say, thank you very much for coming in. We cannot prepare your return. If a taxpayer has after-tax dollars in their retirement plan, that return is no longer within the scope within VITA. So that return is going to have to be prepared by someone else. And the someone else we recommend will probably be a qualified tax preparer. So if they ask where to go, suggest that they go to someone who's able to handle that situation. Probably not an institution that has a character out front of their place spinning a sign saying, come in and get your taxes done cheaply. They will not be able to help them out very well. This is a very complex process. We need to gather a lot of information, a lot of data, trying to figure out how much was actually contributed after tax. I personally do not like doing this. It's a long and cumbersome process. So it can be done. It just takes a little while to figure out your taxable amount. Yes, question? So the question is, when would we actually see someone in this happen? The main area that we'd probably see it is because they have an IRA that they had maybe rolled over from a 401k and it's sitting in the account, and they decided they wanted to try and contribute to the IRA, and they may have made a contribution in a year in which they would not get a tax benefit for it. In most cases, we don't see this within VITA. We don't really have a whole lot of individuals that decided they want to fund their retirement plan and do it in a non-tax advantaged manner. But the way that we sometimes see it is because we have individuals who wanted to contribute to a retirement plan. For one reason or another, they couldn't get a deduction. Either they were already covered by a retirement plan, or maybe their income was too high to get a deduction, but they decided, I want to contribute anyway, so now they have a tax deferred item sitting in their retirement account. And now we have to figure out how much was in there, how much the other contributions were, do a percentage of how much is coming out, and it's a little bit complex of a calculation. So the answer we're most likely going to get, the answer we're hopefully going to get is, I have no idea what you're talking about. Which means that they did not put any money in after tax into their retirement account. All of it went through employer contribution, whether it's through profit sharing, whether it's through some sort of match, or whether it was employee deferred contributions. If that's the case, we're fine. What will happen is we'll just use the amount from line 1 as the taxable amount in line 2A. And what will happen is taxslayer is automatically going to pull that amount over. They're going to assume, unless you put something in box 2A, that whatever is in box 1 is going to be fully taxable. And the position that the IRS has is they like that. Whatever is in box 1, they will gladly take as fully taxable. So again, the question we ask, did you have any money go in with after-tax dollars? And hopefully the answer is going to be no, because that way we can still prepare the return. The answer is yes, they're going to have to start searching for a tax preparer and have to start gathering some information. Okay, and then the same thing can happen if we see a Roth distribution. We don't see a whole lot of those within the VITA program, and we'll talk about some of the codes that we'll see in box 7. Okay. Don't know if we just lost our breaker again. All right. Okay. So for those of you who do get motion sickness, now's a great time. We won't be flying through some of these presentations here. But what we want to take a look at is that concept of Roth distributions. As long as the individual meets all the qualifications for a Roth program, we can handle the return. So either the distribution is going to be fully taxable if they don't meet all the qualifications, or if they meet all the Roth qualifications, for example, that they have taken withdrawals from the Roth account 5 years after they made a contribution, they reached age 59 and a half, or if they have other certain areas, that would be a allowable distribution. Okay. Okay, wonderful. All right, now we're back up and running with the presentation. Excellent. All right. So for the Roth contributions, if we see a distribution coming out, generally if we're going to see some certain codes, we'll be fine. But we have to ask the same thing. If we see a partly taxable Roth account, we cannot handle the return. Good news is we don't see many Roth accounts. Best news, we don't see many partly taxable Roth accounts. So very limited circumstance would we have to turn a taxpayer away for having a distribution from a Roth. But the one thing we do want to focus on quite a bit here is some of these other areas on the form. So we talked about line 1, we talked about line 2A, but we do want to watch. A lot of taxpayers will have amounts withheld from federal income tax. So we want to be sure we enter any amount from box 4 on the screen itself. That will automatically carry over. Particularly our retirees. Retirees have sources of income, but they generally don't have any other withholding. you may elect to have taxes withheld on your retirement distributions. If you have a normal distribution, it's going to be taxable for federal. Most cases, if an individual owed tax in the prior year, or if they owe tax, you may want to suggest that they have taxes withheld if they do not feel like making estimated payments. So just be sure if there are taxes withheld on Box 4, we carry those over. Box 4 is going to be critically important when we start talking about some codes in Box 7. And we'll talk about those in just a second here. So Box 7. This is really going to help trigger how this distribution is going to be reported on the return. As we mentioned, all distributions from a retirement plan, whatever is shown in Box 2A, will be fully taxable on a federal return. When we take a look at these codes, there are going to be a couple things that we want to take a look at. What do the codes mean? The best code we can see is a Code 7. Meaning it's a normal distribution, someone has reached their normal retirement age, and this is a distribution in the normal course of taking their money. Whether it's a required minimum distribution, whether it's a pension, whether they've just taken money out of their IRA or 401k plan. And again, what we'll see is right next to Box 7, we'll see that IRA SEP or Simple box. If it's checked, we check it on the system. If it's not checked, we leave it blank. But what do the codes mean? Well, there's going to be a couple codes that we'll take a look at a little bit more frequently here. The first one that we have, Code 1, is what we call the Kleenex code. Code 1 means that someone has taken money out of a retirement plan before they reach normal retirement age. So it means that they have a premature withdrawal from a retirement account. And how does this happen? Well, what typically happens if you have an employee who separates from service either voluntarily or they're dismissed from their position, and they have a retirement account sitting at their employer, they'll have an opportunity to sit with the HR person as they're doing their exit interview and say you have 3 choices that you can have with that retirement account that's sitting with us. Either one, you can leave the money here, which neither the employee or employer really wants to have happen, or they may encourage them to say option number 2 is you can roll that money over to your own retirement account, either in an IRA or to your new employer, can maybe take those monies in their 401k plan. Or option number 3, you can take the cash today. Well, maybe not today, but in 3 to 5 business days, you can take that cash. We do have a lot of people within VITA that say option 3 sounds great. Do I want to take that money 45 years from now, or do I want it within 4 to 5 days? There's a brand new flat screen TV going on sale next Friday, which would be nice to have. I'd like to have the cash. That unfortunately creates a bit of a tax problem for us, because any withdrawal that comes out of the account is going to be subject to ordinary income tax. So if they take $5,000 out of that account, $5,000 is going to be added to their taxable income. It's also subject to an automatic 10% penalty with a Code 1. So in addition to $5,000 being in their taxable income, they also automatically have $500 due to the IRS. So hopefully they have a good amount sitting in Box 4 to overcome those amounts. Because what happens when you get a 1099-R and you see a Code 1 sitting in Box 7, you may want to start thinking about how you want to present the information to the client, that their expectations are going to be dramatically different than what they have been in the past. The refund will not be as generous. In fact, they may be in a position where they have to write a check to the government, which they're probably not expecting. Again, what we're going to do is we're going to just deal with the information as it comes in. Box 1 or Box 7 Code 1 is probably the worst code we're going to see. There may be a couple other codes in there. On occasion, we may see. I'm sorry. Yes, sir. Sure. Yeah, so the question is if someone takes a loan against a 401k, as long as they're repaying the loan, usually with a payroll deduction, there's no reporting that happens at all. So the only time we see a reporting on a 401k loan is if for some reason they default on the loan, if they are terminated from their job before the loan's repaid, and then that would be issued a 1099-R, again with a Code 1 for a premature distribution. But if they're taking a loan, and there are some situations you can take a loan from your 401k, it's traditionally a 5-year payback with a set amount each pay period. As long as you're paying their loan back on time, there's actually no reporting that happens. Yep. No, so if they get a loan from the 401k, they get no there's no documentation until the loan's defaulted. So what they're going to treat it is actually as if they're borrowing money from their 401k. It's not a distribution yet because they're supposed to be paying it back. Yeah. Okay, sure. On occasion, we may see a Code 2. I'm sorry, yes, sir. Yeah. Correct. Right, yeah. So the code G, and we kind of have a couple letters and a couple of numbers. It's going to look like Sesame Street here, and then we'll go through some colors. But we'll go through some of the lettered codes. Code G is going to be a code that we roll the amount over. That's if the employee took option 2, which is roll your money over from one plan to another. If that money went directly from one third-party administrator to another, if you rolled your 401k into an IRA that you can open at any bank, you're going to get a code G. So what we're going to see is that there is going to be amount in box 1, and box 2A is going to be 0. Nothing's going to be taxable. It's going to be a code G. There's nothing. We need to report the fact that they had money that moved from one to another, but nothing's going to be taxable. Theoretically, if you decide you want to take money out of your account and you can roll it over yourself, so they'll write a check to you, and then you have 60 days. Not 60 days including holidays and weekends. It's 60 days from the date you get the check. That money has to be back in a new account. Whatever has not gone back in is going to be subject to tax and the additional penalty. So if you take $5,000 out of the account and the account provider says we're going to do an automatic 20% withholding, so your net check is $4,000 because they're withholding $1,000, and you decide after 50 days, maybe that flat screen TV isn't really what I want. I'm going to go ahead and put that in my own IRA. And you take $4,000, you go to the local bank, set up an IRA account. What's going to happen is you're going to have a $4,000 rollover, a $5,000 distribution, so you're still going to have $1,000 subject to tax. You can make some modifications within TaxSlayer to say that there is a rollover. However, that doesn't happen very often, so we're not going to encourage you to go in and modify the 5329 or the 1099-R. But if you do run into that situation, especially if you haven't seen it before, feel free to grab your site coordinator, ask them the question. In most cases, if there is an exception to a penalty or there's not fully taxable, the client will be more than happy to take some additional time to make sure we get that information entered correctly. But if it's a code G, it's not going to be reported as taxable income. The other codes, code 1's the worst one. Code 2 means it's taxable, but there's no penalty. Generally, we may see that in situations of a divorce where someone's getting a 401k plan from a former spouse. They're allowed to withdraw the funds. If it's a qualified domestic relation order, we don't need to worry about it. That's going to go directly to the third-party administrator. So you may see someone who's not retirement age taking money out of an account. They're going to get a code 2. Code 3 would be on account of disability, that they're taking money before they're at retirement age, but they're considered disabled, so there's no penalty associated with a disability. If they're inheriting an account, if they're a beneficiary of an IRA or 401k, they can take the money out. Again, it's going to be taxable to them. It's just not going to be subject to a 10% penalty. And then we get into those lettered codes. The code G is going to be associated with a IRA or pension 401k that's being rolled over. And the other codes, the H, the Q, and the T, are going to be related to Roth accounts. So those are going to be related to whether or not that Roth account's a direct rollover, that'd be code H. Whether it's a qualified distribution from a Roth, again, meaning we won't have taxability on it, or code T, meaning it's a non-qualified, but there is an exception that applies. And with a Roth, that could be for things like education or first-time home buyer, things along those lines. Okay. For the most part, 90-ish% plus of our 1099s should be relatively straightforward. We'll see an amount in box 1, we'll see an amount in box 2A. If there's nothing in box 2A and the administrator has taxable amount unknown, we ask the question, did you have any after-tax contributions? If the answer is no, okay, there we go. All right, it's back up and running. All right, just make sure it doesn't go to sleep on us here. Okay, so if the answer is no, they didn't have any after-tax, we're just going to use the amount in box 1. TaxSlayer automatically fills it in box 2A, and we're still good to go. Other than that, we're just going to follow the codes. Code 1, if and when you see it, be sure to take a look around your site, grab the box of tissues, and be prepared for a little bit of a discussion in about 5 or 10 minutes. Yes, sir?
A suggestion.
Yeah.
Look over the 1099 as they sit down with the person. I have a person that just sold a 1099, okay, we did all this stuff.
Yep.
We get into it, finally look at that, box 7 is a J.
Oh, okay.
So we were
Yeah.
halfway before they through it. Oops.
Yeah. Yeah, that's a great point, because really the things that we take a look at really is probably our 1099-Rs that's going to take us out of compliance or out of scope, or some things like self-employment or other things that might be a little bit more complex. But really when they call up and they go through the screening process, they might not know that they have an unusual 1099-R. You may see a couple different codes in there. We'll talk about, for state and local purposes, if you see more than one code in there. You may have a 7D. And that's just going to indicate that there's some things we need to do from a state taxable position. But if you see a code that we can't work with, yes, it's probably a good idea to probably start with the 1099-Rs and start excluding those from that process. So if you have any questions with those, the 1099 codes are going to be on D41 and 42. So that's a complete list. And as you mentioned, a code J is going to be an early distribution from a Roth. It's going to be out of scope and we can't handle it. So as you get the 1099-Rs, maybe the first thing you want to do is take a look at box 7, take a look and make sure it's a code we can work with. Again, if you see a box 1, hopefully, or code 1 in box 7, hopefully you see a large amount sitting in box 4. Because maybe they followed the instructions of the third-party administrator and had 20% withheld, which generally gets them fairly close to covering their liability. Although, if they have some other things going on, like affordable care premiums, that they're getting an advanced tax credit, they may throw that off. It may throw off some of their ability for earned income tax credit. It may throw off some other things as well. So just be prepared, we may have some discussion. Yes? Okay. Yeah, so 9B is kind of taking a look at what we'd call the simplified method of reporting. And we probably won't go into that too much here for the basic account, but we do talk about that quite a bit in the 1099-R training. If you have a situation where someone has an account, and typically we see this from a government pension account, whether it's a former government worker, perhaps either someone working for the railroad or a fireman or firefighter or a police officer, they generally have an amount that they've contributed to a pension plan or annuity. What happens is that part of that contribution that they made is their own money coming back, and that's not subject to tax. So if you see an amount, and we could see something in either box 5, which is typically the employee contribution for that year. If it's in box 5, typically we'll see box 2A already adjusted. If it's in 9B, it basically means how much has the employee contributed overall, and we may need to take a look at a simplified method of reporting. You've seen it in 9B more often? Okay. Okay. So if we do see something in 9B, we may indicate that we have a simplified method, and that would be reported on the D37 of the 4012. In most cases, if someone has a simplified method, the best part is that they're generally not coming to us the first year in which they have it. So if they have a simplified method, the calculation is probably already shown on their prior year return. If they are coming in for the first time with a simplified method, we can certainly talk about that. If you see it in a basic format, please talk to your site coordinator and we'll walk through that process with you. It's going to take just a little bit of time to go through it. And we may take a little bit of time in January to kind of walk through that process. And if you really have questions with the 1099-R, we are going to have that training available. So it'll be narrated by me. Again, it's going to be like books on tape. And if we'll have it available for you to take it in your car with you on your commute back and forth, but you can listen and watch what's going to happen with 1099-Rs. So we'll go through the simplified method process of when that'll be applicable and how we'd go through in Tax Slayer to make sure that that's recorded appropriately. Yep, absolutely. Great. Any other questions on the 1099-Rs? Any words of wisdom from returning volunteers on 1099-Rs? Are they hopefully as straightforward as what we've mentioned for the most part? On occasion, I mean, the nice part about tonight is if we see it, we type it. And that's what we do. There's not a whole lot of thought process that has to go into this to this piece of this evening. So really what we take a look at is once we enter the information on that 1099-R, we did see that the box 7 was checked as an IRA separate simple. So the information is going to be showing up on line 15. That $5,621 is going to be showing as a distribution from an IRA separate simple. So because there was no difference between a taxable and gross distribution, the entire amount's just going to be shown on line 15B. If we'd see a difference, the question came in the back about a code G. If we'd have a code G, and this would have been a qualified rollover, we'd see that 5621 in line 15A and a 0 in 15B. If there'd be a difference between how much was taxable and how much was a gross distribution, we'd show the gross in 15A and the taxable amount in 15B. That's automatically going to be calculated by TaxSlayer. So all we have to do is make sure we enter the information correctly. And what we can do, generally the nice part, if you want to self-review a return, take a look at your documents again and make sure they all came over to the appropriate line on the 1040. It's going to save you some time, and also when you do your secondary review, they'll be taking a look at the same items. Oh, sorry. Now flying around here. All right. Again, motion sickness, don't look up here. All right. Sorry, I'll try not to hit the button too often. Trying to make sure this thing doesn't go to sleep. Just two more forms we want to be talking about this evening. One is going to be unemployment compensation. So the interesting part about the federal government, if you have wages, if you're actually working, you have to pay taxes on those earnings. Makes sense, right? If you're working and you're getting an economic benefit, you should pay taxes. The government also taxes money you get for not working. So if you're collecting unemployment benefits, that money is subject to federal income tax. It's not subject to state income tax, but it is for federal income tax purposes. So if you get unemployment benefits coming through with one of your clients, they're all going to be reported on a 1099-G. For Pennsylvania purposes, they're all going to be paid out of the same office within Harrisburg. So again, as long as you're not the first person at your site to have to enter a 1099-G, this is going to be very, very easy for you. You enter the 1099 information as you see it, the employer identification number. If anyone else has done it before, it's automatically going to populate. All we need to do is drop in the numbers that we're going to see for the unemployment compensation, which will be in box 1. And when someone signs up for unemployment compensation, they do have the option of having federal income tax withheld. Again, because this is a federal item of taxable income, hopefully they have some withholding. If they do, it's going to be shown in box 4. So we'll just enter the information as we see it. Once we do that, it's automatically going to carry over to our 1040 and show up on line 19 as unemployment compensation. Any of those withholdings that we had talked about are automatically going to flow to the second page of the 1040 in terms of federal income tax withheld. All right. Yes, sir. Question?
Is that 1099-G shown
That's a good question. I think we may just have a sample of it here in your handout, but we don't really have much detail on the 1099-G in the 4012. Yes, yeah. So you can enter it as a 1099-G, or you can go to the unemployment area. The nice part about TaxSlayer, if you know it's unemployment compensation, you can go to line 19 and link back to the entry form. Or you can type it in the search bar and say, I have a 1099-G, I don't know what it means. Or you can see it says unemployment compensation, so you can type unemployment in the search bar, and it's automatically going to bring up the entry field for that. The 1099-G can actually be used for a couple other things. 1099-G is actually any government-based payment, so it's actually coming from any state or local refunds you may have had in a prior year. Most places don't actually issue those anymore, and we'll talk a little bit more about that as we get to deductions. They can also report gambling winnings on a Form 1099 as well. So you may see those. So there'll just be a couple other areas that the 1099-G may be used for. Good. Any other questions on the 1099-G or entry? Okay. Last thing we want to take a look at is our Social Security statement. This is going to be our 1099 SSA, or as they'd like to do it, it's the SSA 1099. They go in reverse order. So what we're looking at here is a traditional Social Security statement. Obviously, we'll probably be looking at a 2017. Don't look at the copy up on the screen. That's 2014. Do not enter prior year information into a 2017 system. All right, so just kind of take a look at it, make sure it's from the correct year. This is catching to see if anyone's paying attention that we're using different Social Security numbers in different forms, but hopefully no one's bringing in more stuff than what they need. On occasion, we do, like I said, we do have clients that bring in all their unopened mail, and we have the opportunity to kind of go through there. You know, we'll find some nice tax documents. Maybe you can let them know they might be a winner in the Publishers Clearinghouse sweepstakes. And maybe they can fill that out while you're working on their return. But if they have anything from prior years and they say, oh, by the way, I just brought all the stuff that says important tax information. Here's some information from 2015. Hopefully they already filed the 2015 return. If not, we can work with them. We can get even more returns taken care of. But hopefully we're taking a look at the 2017 information. The SSA 1099 is going to show a couple different pieces. The main thing we want to take a look at is how much do they get in a net benefit paid by Social Security. And what they mean by net benefit is not exactly how much they get in the check each month or their direct deposit, but how much was their benefit as long as they didn't have any repayments or any other type of withholdings on their Social Security benefits. So typically what we're going to see for most clients, what they get in box 3, benefits paid in the current year, will be the same as what's going to be in box 5. The thing to keep in mind is just take a look at that little pink box in the SSA 1099. That's going to be an amount that's going to be entered into our TaxSlayer program. So if you take a look at the D45, it'll go through a little bit of information on what the SSA 1099 is going to look like. It's going to be fairly straightforward, so some of these information pieces you'll see in the 4012 are just going to be pointing at a box and saying, put it in TaxSlayer. And that's exactly what we're going to be looking at here. So the main thing we're going to be taking a look at is going to be our amount in box 5. That's going to be the amount taxable for the current year. If they have any withholding, we'll take a look at that. That's also going to be coming out of box 6. One thing that's going to be a little bit different. We do have the opportunity for taxpayers, particularly if they've already reached the age of Medicare, to have their Medicare withholdings automatically taken out of their Social Security benefits. Those would be reported here in any description showing up on the left-hand side, or my left-hand side. Still your left-hand side. Good. All right, that works out all right. Alrighty, sorry. Trying to look in the rearview mirror here and seeing how we're doing. But to be on the left-hand side of the 1099, it's going to show how much they had withheld in Medicare premiums. What we have is an option within TaxSlayer to enter that directly in the input field. So if you take a look at the 1099 area, we can actually enter the total amount of Medicare premiums. So we can enter Parts A, Part B, Part C, and Part D. So in this case, we actually have Medicare Part B premiums deducted from their benefits of $1,200. When we go into TaxSlayer, we can just simply put that $1,200 in Medicare withheld. That'll automatically flow over to our Schedule A itemized deductions. We do not need to enter that amount again. So again, what we take a look at is Part A, Part B, Part C, or Part D would all be deductible insurance premiums. That only applies if they're itemizing deductions, which we'll talk about in 2 weeks, and if they get over the hurdle for medical expenses, which is somewhat difficult to do. And we'll talk a little bit more about that next week as well. Okay, so today is really kind of an overview of forms. Much different than last time, right? We're not going through checklists, we're not having to answer questions with each other. It's more of an opportunity. If I see a number, I type a number. If I see the form, I know where to put it, and it's automatically going to flow in. So if we enter that 1099 information, again, what we're going to take a look at is how much do we have in our pink box, our box 5 there for net benefits, how much do we have in any federal withholding. We don't often see this in a 1099 for Social Security, but you do want to double check it. Every once in a while, we do have a client who has Social Security having federal withholding, so we don't want to miss it. So you always want to just double check and make sure it's there. And just be sure you enter the Medicare withholding. That'll automatically flow to the return. So if we see Social Security, what's going to happen? That's going to be entered in line 20A. Social Security will be taxable somewhere between 0% and 85%. You do not need to memorize what those amounts are. You do not need to know how to calculate the taxable part of Social Security. TaxSlayer is going to do that automatically for you. So what it's going to be based on is your other sources of income. How much other taxable income do you have? How much non-taxable income do you have in terms of tax-exempt interest and dividends? So it's going to be based on a calculation that will happen behind the scenes. There will be a schedule that will print out to show how it gets there in case the client's interested, or in case you have a client that comes in and says, I didn't know the government's allowed to tax me on the money that they pay me. Oh yes, the government's allowed to tax you on anything that you get, unless they have it otherwise exempted. So what we wanted to cover tonight are a lot of these basic forms, the ones that you'll most likely see within your purview. Some you may see only tonight, and for purposes of your certification test. You may never see them again within VITA. But we do want to show the common ones, how they're going to be populating. Again, if we see some of those other forms of income, things like jury duty, things like gambling winnings, those would show up on line 21. There's actually an opportunity for those to be populated. We don't often see those, but if someone reports that they have some gambling winnings, we'll talk about how that would be entered. If they have jury duty pay, if they had the ability to go get selected for a jury, and they get their $6.50 a day or whatever the county's paying for jury duty, they typically do not get a form from the government. They'll actually just get a pay stub. That would simply be reported on line 21. Unfortunately, that is also taxable for state and for local purposes. So we'll talk about that as we get to our state and local. But what we're going to do is tax layer is going to add up all those items of income. That's going to be on line 22. That's going to be the total amount of income the government can possibly tax. And in 2 weeks from tonight, we're going to start talking about how we get that number to be even lower, to get to taxable income, and how we can apply some credits and other deductions to see if we can actually help maximize the taxpayer's refund. So that's basically what we wanted to cover today. As you can see, we're flying right through the 1040. We're all the way down to line 22. By the time we meet again in 2 weeks, we'll be covering the rest of the first page and about the first third of the next page. We'll be almost through the 1040, 3 months in advance before you're going to see your first client. But we do want to try and make sure everyone's feeling comfortable. Hopefully you have enough information next Thursday to be able to talk at Thanksgiving dinner about what taxable income looks like when you start getting questions as you say, I'm volunteering for VITA next year. And everyone says, that's great, now you're a tax professional, I have a couple questions. All right. So if you do get questions, feel free to bring them 2 weeks from tonight. I'd be more than happy to answer them. They don't have to be yours. You can frame it. A friend of mine has this question. I'm perfectly used to that. That's not a problem. We can handle that. So with that, I think we have a couple more announcements from Ezra. But other than that, that's what we're looking at for income this evening. All right. Thank you very much.